what it would look like to actually assume a loan and the complexities that can be involved in doing so. First, what type of loans can be assumed? Because it's not every property. In reality, it has to be a certain type of federally backed mortgage in order to be eligible for assumption. And those types of home loans are FHA loans, VA loans, and Department of Agriculture loans. So there are even some federally backed mortgages that are not eligible. So you need to make sure that you have an understanding of whether a property even qualifies for the mortgage to be assumed. And it starts with that mortgage being one that is a certain type of federally backed loan. Once you've identified a property, you've agreed to the sale and the assumption of that mortgage, it now is up to the loan servicer of the current mortgage that's going to be assumed to facilitate the transaction. And this is also a difference from a conventional home purchase. See, typically, if you have a current mortgage on a property, it really doesn't matter in terms of the sale itself, because you as the buyer would be bringing your own lender to the process. So if, for example, the person who owns the property has a mortgage on it that's by regions, but you have your lender as Bank of America, Bank of America is going to be the one that's going to be doing most of the communicating with the title company, getting everything set up. And there's not going to be much involvement with the seller of the property. With an assumption, however, you're taking over the current mortgage. So if that person does have their home loan with Regions, you're going to be needing to communicate with Regions in order to process the transfer of debt from the seller's name into your name. That is the second potential complexity, because you will find that the process for doing this is nowhere near as streamlined in terms of most lenders' familiarity with it or the ease with which they allow you to work through the process as compared to issuing a new loan. And there's a big financial reason for that, because most lenders, when it comes to processing a new loan, they're going to be able to charge origination fees that are, say, 0.5% or 1%. So think about a $500,000 loan. If they're charging a 1% origination fee, that's $5,000 that they're getting as a fee for that process. With mortgage assumptions, however, it's very different, because based on the loan that they are allowing this person to assume, there's a cap on how much they can charge for this process. If you're looking on screen, you will see that when it comes to a loan that's an FHA loan, lenders are only able to charge a maximum assumption fee of $1,800 to process that transaction. For VA loans, that maximum fee is $300 plus the cost of a credit report. So you can see from a financial perspective that there is a much lower incentive for a lender to help you assume a loan from a current seller than there is for you to just have a new loan that's originated to cover the entirety of what's owed on the property. And even if they're not actively trying to obstruct, because this is something that's simply not done as frequently, you will find that the infrastructure to process mortgage assumptions can vary widely from one lender to the next. You might have one lender that does it all the time and has a process where you can do it online and it's very easy to do. Whereas you might have another that requires it to be all done on paper and through snail mail and just doesn't have as much of a layout for how that process can go smoothly. So if you're going through this process, you need to be aware that even as annoying as buying a home is in general, when it comes to assuming a mortgage, you can add on top of that the potential frustrations of working through a process that is not as streamlined as a conventional home loan.